All right, hi everyone. Welcome to today's webinar, Home Runs and Strikeouts, How Model Complexity Leads to Backtest Success and Out-of-Sample Strategy Failure. So today's speaker is Chris Covington. He is a principal at Vista Strategies, where he's responsible for managing the factor-based systematic equity strategies. Prior to joining Vista Strategies, Chris was a partner, senior portfolio manager, and researcher at AJO, a large quant equity manager, where he was integral in the development and launch of the global and international product suite, as well as driving investment strategy and research across the firm. Before his time at AJO, Chris spent 8 years at Numeric Investors. He actively donates his time in the nonprofit sector, most notably as treasurer of an anti-recidivism organization in Pennsylvania. And Chris received his BA from Colorado College, an MS from Boston University, and is a CFA charter holder. Thank you, Chris. We're so happy to have you today.
Thank you, Paige. I appreciate the great introduction. First and foremost, I think I just want to thank everyone for listening. My hope today is to impart you with some knowledge or some insight into avoiding an overfit back test as you go down the road and trying to develop your own investment strategy. So prior to delving into the actual topic, I just wanted to give some background on Vista as a firm and our systematic equity effort. The firm has been around for about 15 years. It was founded by a group of gentlemen, including Andre Perold. Anyone who's ever done any transaction cost research should know the name, as he founded the field. The quant effort at Vista is centered around taking a simple yet novel approach to factor-based investing. We're highly focused on creating a product where our actual results align with our back tests and where our clients can understand our investment process from beginning to end. Our quant effort is team-focused. I want to note that there's nothing in this presentation or that comes out of our group that doesn't have a considerable input from every member of the team. To that, I'd like to thank someone who I believe is listening, Rahul Gupta, one of my colleagues, who did a lot of the heavy lifting in terms of analysis on this. So jumping right in, on the surface, baseball is a very simple game. Whoever scores the most runs wins. On the surface, investing is also a very simple game. You buy stocks that are at low prices and sell them at higher prices, and you make lots of money. Over the past 30 years, however, the simplicity of both baseball and investing have been overrun by people like myself, statisticians, and also an immense amount of data. The growth in computing power and data availability is partially to blame, especially recently. If you're a baseball fan, every time you watch a baseball game, there's a new inane statistic, something like the number of times a batter has gotten a hit with 2 outs when the outside temperature is above 73 degrees and the pitcher's name begins with the letter K. If you've read academic research around quant investing, you get some similarly inane publications as well. The true driver of this, though, is really tied back to human bias. Our bias to be more complex, to overthink, to overanalyze, and of course, the bias to buy into our own BS. I've always said that there's one person I can always convince that my research result is true, and that person is me. And again, that's important why we do things as a team here at Vista. The tendency towards the complex often has negative implications when building a forecasting model. We'll use a study of baseball to illustrate the how and the why, relating back to quant investing throughout. Before we delve into the interesting stuff, I wanted to explain and frame the baseball study. The goal of the study, as mentioned before, is to demonstrate the pros and cons of additional layers of complexity in modeling. We decided to use the field of baseball instead of investing for a few reasons. First, it's a good corollary for investing. As noted above, statisticians have taken over the sport over the past few decades, starting with the Moneyball era made famous by Michael Lewis's wonderful book. Additionally, it's a venue in which we, the research team, can approach with very few preconceived biases. It's really as close as we can come to a blind study. In fact, very few of the members of our team actually can tell the difference between a batter and a pitcher. The results of the study, in short, support additional complexity in your model to a degree, but illustrate that the risk of data mining increases with each step. So let's dive in. So the breadth and cleanliness of data in baseball is actually pretty impressive. We found data going back to the 1930s. That data had very few obvious errors. Anyone that's worked with investment data knows that we're not so lucky. Surprisingly, the data was much easier to use than investment data. It was mapped better, and just very easy. In this exercise, we utilize player level statistics, how well they hit the ball, pitch the ball, field it, etc. And we created forecasting variables from these statistics that were the average of the past 2 seasons of each statistic, similar to an accounting measure that you might create for an investment factor, trailing cash flow, normalized earnings, something along those lines. We then aggregated that data for each team using the start of season opening day roster. As an example, we took the total runs for each player on a team, summed them up, and then used that number, ranked the teams by that number, and used them to forecast wins in the subsequent, the next season. Incidentally, our final model did forecast the Red Sox would have the most of the wins this year. As we look out our window right now, I can see Fenway Park. I promise you there was no bias. That's what the numbers told us. We're quants. We don't manually interact with our models. Perhaps the simplest. This slide, actually, before we go forward, contains the individual factors that we utilize. There's a lot to take in here, so I'll give you a moment to just digest. These are basic baseball statistics. We categorize them into groups: batting, pitching, and others, similar to how most categorize variables in the industry: value, momentum, quality. Before anyone asks, many of these variables do have mutual relationships or connections. That's what we nerds call collinearity. We will deal with this in several ways as we go forward. So perhaps the simplest predictive model that we could create is a single factor sort. This is using a model that uses a single variable that we think has forecasting power, ranking whatever thing that you're modeling by that factor, and using the ranking as your best guess of the outcome of some characteristic in the future. In baseball, one of these factors, in the table above, for instance, maybe it's runs or pitching wins. We would use that to forecast future team wins. In investing, it might be price to earnings ratio, the stock's trailing 9-month performance, or the number of times it's mentioned on Twitter that we would use to forecast future stock returns. If you're using that Twitter signal, please let me know what you're investing in so I can take the other side of that trade and make myself a decent amount of money. There are many benefits to constructing this type of model. First of all, it's simple to create. There are very few considerations that are required. You really just need a single data item. More importantly than that, it's very easy to understand. So as the user or seller of this model, every forecast or outcome is very easy to tie back to the initial factor. In my baseball model, using pitching wins, I know exactly why a team is chosen to have wins in the next year, or forecasted to have wins in the next year. Likewise, if I'm choosing stocks based on a single factor, such as price to earnings ratio, I know exactly why that stock is in my portfolio. During periods where my model fails, and all models do fail, it's simple to explain. So pitching wins is not a good predictor in this period, or in the chart above, showing forecasting power of pitching wins, the weaker performance in the 1990s, for instance. For our stock picking model, high price to earnings stocks at times will not do well. As a researcher, it allows me to evaluate the model and the original intuition underlying it. As a portfolio manager, it allows me to clearly understand and convey both the process, the performance to clients in good times and in bad. So here on this chart, we just summarize the outcomes of our simple models, or what in nerd speak is our univariate models for our baseball statistics. For those that are baseball fans, much here makes perfect sense. The number of runs scored by players in previous years is most explanatory in forecasting wins. Like with any sport, more points generally translates into more wins. Importantly, the explanatory power R squared for these models are very high. So if you look on the left axis, that shows the R squared. Really, the good ones are in the the 0.2 to 0.3 range, maybe 0.15 to 0.3. This is far and away greater than anything we'll ever attain in the world of quantitative investing. Even the best of the best, so your Renaissance technologies and your Two Sigmas and all those guys, they're looking at a few percent R squared at best. This is really a key difference between the baseball study and quant investing, and something that we'll delve into or discuss later on. So we have our simple single factor sort. This model has many benefits. It's easy to understand. As you probably are all thinking, there are also a lot of drawbacks. Those drawbacks can be overcome by taking a more complex approach. The simplest increment of complexity is adding additional factors to a model. While a simple model is prone to longer periods of underperformance or high periods of volatility, combining two factors that are not highly correlated will reduce the impact of tough periods, creating a smoother path. The chart here is very simple and illustrates this in the realm of factor investing. The yellow bars correspond to the right axis and show the IR of modeled decile portfolios, so where we take the difference in return between the top 10% and the bottom 10%. The blue and gray bar correspond to the left axis and are the return and risk. Both the momentum factor and value factor are very good on their own at sorting stocks. The characteristics of the blend, however, are far better. The return is slightly better than value on a standalone basis and blows momentum out of the water. The risk is better across the board, and that's why your yellow bar is higher. This is highly intuitive. It's not a groundbreaking result, but it's nice to see it proved out empirically or in data. But it's really a kind of a basic, simple example of the benefit of adding some level of complexity to your process. This story also plays out quite well in our baseball study. So in these charts, we use rolling 10-year rank correlations to illustrate the power of a few simple models over time, as well as our model with one simple layer of complexity, and that's just combining a few metrics, similar to what we did with value and momentum on the previous slide. In almost every period, the blend, which is represented by the dotted line, outperforms the simple single factors. The chart on the left shows pitching wins. Notice the few periods where wins underperforms and the runs metric smooths out that outcome, and vice versa in the 1990s, where the relationship there is flipped. The second chart is more the same, just different selection of variables, more diversity, more complexity. The result is better. We could have blended almost any selection of these baseball variables to achieve a better outcome than the variables on a standalone basis. Again, very intuitive, not something that's going to win a Nobel Prize, but again, nice to see spelled out with empirical data, and another, also to remind us of kind of the principles of investing, model combination, diversity, and so on and so forth. So we saw that adding some complexity was helpful, but we know that there's never a free lunch. Adding complexity to a model, as noted, can create a better outcome, but the question really is, what is the cost? Each time we add a twist to a model, that model becomes more difficult to understand, becomes more of a black box. This opacity is key when you're thinking about building a factor model. Some innovations will be worth the loss of understanding that they bring along with them. Some will not. Determining this is actually more of an art than a science. I wish I could give you a simple rule. A chart we'll get to later on, though, is kind of a demonstration of a good study that everybody should do as they're creating back tests and running models. Just thinking about that loss of opacity, for example, when we blend value and momentum, it's no longer as simple to understand the makeup of the portfolio. It's not made up of the stocks that perform best over the prior period. It's not made up of the stocks that are the cheapest compared to the earnings. Now it's some mix of both. The two-factor model, you have the interaction of the two factors that ensures that this outcome isn't exactly clear. The correlation structure underlying those factors, or how related those models are, is not static either. So you could spend a lot of time model today. If that correlation structure changes, that interaction term will change in terms of its impact on your outcome. And then 3 to 6 months from now, the conclusions that you draw today are not as applicable or have changed. If you extend this to a more complex implementation involving several factors, the degree of interaction, expands immensely. You have interaction, kind of bilateral interactions of all the factors, and it just makes understanding what's happening in your model or why something is being chosen not clear. And think about this when you layer on a machine learning algorithm that's opaque by design. The problem is just protracted. Additionally, getting back to model performance and understanding, when your model underperforms, that's when you really want to understand what's happening. As you start to layer on complexity, you can no longer have that view. So you can draw conclusions, you can spend time trying to understand, but it's more difficult to evaluate whether that underperformance is just a down cycle. As I said, all factor models are cyclical. They have periods of outperformance and underperformance. Or if it's really, the underlying thesis no longer holds. And we have a few examples of that in factor investing. And there's also one interesting one that maybe we could talk about at the end, that we found in the baseball study. Essentially, though, when you're thinking about your model, all of your intuition on that model that you had in the simple implementation is lost. So next, we illustrate kind of taking that complexity to the next step, or extreme complexity, and the impact of that lost intuition that we mentioned on the previous slide. As we think about modeling both in baseball and investing, adding complexity through adding factors is beneficial to a point. The second factor has great impact. The more that are added, the less impact there is. Factor 20 is less useful than factor 2, and factor 21 is less useful than factor 20. That degradation continues. It's really based on, if you think about the principle of diversification and portfolio construction, it's very similar. So your benefit is a function of the correlation of the underlying measures and the power of those measures. At the point where there are no new factors left, or additional factors don't add any value, we shift focus to figuring out new and exciting ways to combine factors. And this is largely where the quant investment industry has gone over the last several years. How do we choose factors, which factors to use? This is more fun from a research perspective, but again, adds so much additional complexity that it makes the outcome very hard to understand. There are many approaches that one can use. All are likely employed somewhere in the industry based on beliefs, skill levels, so on and so forth. The naive approach, or what we call very simple in the chart above, is based on the prior that it's difficult to determine which model will perform best next year or the next 5 years. So take an average of all the models and move forward. A bit more complex and probably more popular, used at a lot of places, is using a simple linear regression. This builds model weightings based on how factors have performed in the past, or how much of stock returns they've explained in the past. It accounts for the interactions of factors. However, it assumes that all of the inputs of your model are unrelated. Well, that doesn't need to be true 100%. As you start to add more highly related variables into your regression, it doesn't handle that well. So at times it will, assign more weight to one than it'll give you all of one and none of the other, rather than a little bit of both. We know that some of the variables in our baseball data are highly related, and we also know that a lot of variables in investing are highly correlated. So think about price to earnings and price to cash flow. If you were to throw those into a regression, a simple linear regression, it might be difficult to understand the output. Taking the next step up the complexity spectrum is something like a ridge regression or a lasso. So typically, people have started grouping these things into machine learning. I really call it the pessimist's approach to linear regression. It's similar to the previous step, but handles related variables much more effectively, and kind of adds a layer of skepticism, limiting the impact that any one variable can have. And finally, the most complex is the support vector machine, or your pure data mining tools. You could throw a neural net in there as well. These are machine learning techniques that uncontrollable will just transform data until a relationship is found. And as you can imagine, the farther we move down the complexity spectrum with these techniques, the more difficult it really is to understand the relationships that the models are capitalizing on. Are their relationships stable? Do they make sense? These are really questions that we can no longer answer, especially as we get down into those very complex methodologies. So we used these techniques, the four listed on the previous page, with our baseball data in an attempt to build a model that's effective at predicting team wins in the next year. Because these techniques by design are tuned to the period in which they're created, the approach that we thought was better was using an in-sample and out-of-sample method. So basically, all this really means is that we created a model on one set of data and then tested it using a future period on which the model was not built. It's like a back test versus a live period in investing. We used a rolling 10-year in-sample period or back test period, and then evaluated how our model performed in the next 5 years as our out-of-sample period. And then we took the averages, the average explanatory power in both these periods for all the models, which is what you see listed above. The sign of a reliable model, and something that I alluded to earlier, this is kind of the one metric that you might use as you're building a model to understand whether or not it's overfit, is kind of the in-sample to out-of-sample ratio. If your in-sample to out-of-sample ratio is close to 1, that probably means your model is pretty well specified. If we look at our complex method, or here we use the support vector machine, there's a steep drop-off in the yellow line in the presentation. This tells me as a researcher, as a user of this model, that methodology came up with some combination of factors that was or utilized those factors in a way that almost perfectly explained the past. When I applied that model to forecast the future, it didn't work very well, right? You see, we have an R squared of almost 0.85 in the in-sample period, and that drops almost 50% in the out-of-sample period. To think about what this means in terms of investing, if you were to consider something like an external event, like the earthquake in Japan in 2011, the stock market dropped precipitously. Any model that was able to rank stocks in a way that lessened the impact of that drop would look good in the in-sample period in which that occurred. When it took that model and applied it out of sample, there's no earthquake, there's no nuclear meltdown, and therefore the model doesn't perform as prescribed. Really, if there's only one piece of information to take away from this presentation, I think it is this chart. Our data mining tool performed as prescribed and was almost perfect in sample, poor out of sample, as I mentioned. Additionally, I'm not sure if this is significant, but you can see the degradation continues the farther you get away from the in sample period. So in year 4, between year 1 and year 4, you've got a almost a 5% drop in explanatory power. Our less complex tools actually performed much better. So the linear regression did pretty well. The interpretation here is that the future behaves somewhat like the past on average. And so the model weightings generated by this methodology were very good at, or fairly good at, forecasting kind of at the same degree out of sample. The winner is the ridge regression. This, as mentioned, this is a methodology that's built to handle related variables. It added a great deal of complexity to our process, but based on our understanding of the data and what we needed to do, it was really the right tool for the job in this instance. And the complexity added was really worth the loss of understanding and intuition. So throughout this talk, we've tied back most of the baseball study to investing. There are some key distinctions that make the addition of complexity a riskier proposition in the field of quant investing, and I think we should point those out. And first is that the signal-to-noise ratio is much lower when we're thinking about forecasting models in the field of quant investing. On the last slide, our baseball models explained 50 to 60% of outcomes at their very best. That's probably 30 or sometimes even 40 times as powerful as a good investment model. We did a study here where we looked at the return to a factor that explained 50 basis points of stock returns in the future. So we used a perfect forecasting model and a noise variable, combine the two. And that gives you a return. So 50 basis points gives you a return of 5%. So, that's pretty good. If you get it up to 1%, you're at an 8% return, and you're driving a Bentley. But to think about how small that explanatory power is, it's in proportion of taking a sip out of a can of Coke and that sip's size to the rest of the can. So just really small. When there's that much of the outcome left unexplained or that much noise, the likelihood of finding a false relationship is far greater. There are many stories and examples of this. Strategies created that hold no credibility, using letters of the tickers and stocks to build a portfolio, for instance. More dangerous, however, are the spurious relationships that are kind of less far-fetched. So factors or strategies that could make sense or that a researcher is able to build a story around. If you think about academic research in the field of asset pricing, in today's world, it's rife with these false relationships, and a lot of that boils down to just the high amount of noise. It's very easy to find a false signal, and therefore it's really easy to kind of build a misfit model. This also opens the door for the misapplication of data mining tools such as that we mentioned earlier, the SVM, neural nets. They're kind of the try until you find type of tool. So if they're not used very carefully, or if the person using them doesn't have a lot of experience or understanding, they can really drive you to an overfit outcome. Also related to the low signal to noise ratio or the high number of non-stationary relationships, or relationships. What this means are the relationships between variables that don't persist, so they're spurious, ephemeral. If you think back to the earthquake in Japan, that's one type of example. This material affected the outcome of stocks, but it was also very short-lived. More common and less apparent examples are, driven by economic condition changes, industries evolving, and so on and so forth. Because of this, it's important to understand what a model is doing and why. This mandates recognition and an avoidance of unwarranted complexity, or as we stated before, avoiding the complexity bias. So in conclusion, or to sum it up, some complexity is likely better than none. If you think back to our two-factor model or even our ridge regression, we've achieved a better outcome by adding a complex element to our model. It's incredibly important, though, when we're adding that complexity to understand the tools that we're using and to apply the right tool. Again, the ridge regression was the tool that best dealt with the characteristics of our baseball data. A pure data mining tool in this case was dangerous, and in many tools or many cases it is, because it has the propensity to try to find a relationship, regardless of kind of the meaning under that relationship, or it's a try until it finds sort of tool, as I mentioned on the previous slide. It's also important to note that no one's going to solve the market. There's a great movie, Pi, that came out in the 90s about a guy solving the market. It's fiction. So again, if you can explain 50 basis points of returns, you do really well. If these new tools and data sets that we see were a vast improvement in our line of work, we'd start to see an immense separation in outcomes. So a divergence between the users and the losers. We're just not seeing that. There are definitely applications where these tools and data sets are very interesting, but they're not gonna solve the market. So if you're using them and you're finding R squareds in the neighborhood of 5, 10, 15%, that probably says that perhaps you have an overfit outcome, or maybe you're not applying the right tool for the job. Really, as we do here, my best advice is to find a simple approach to investing that makes sense. It's understandable, robust over long periods of time, and that will create value both in sample and out of sample. So that's all I have for everyone. Happy to answer some questions at this point. Okay, so the first question, what's the factor model sweet spot? 2-factor, 3-factor, more? This is a really great question, and something that I think whoever you ask will likely give you a different answer. I think really thinking about it at its core, there's no right answer. A lot of it depends on what those factors are. So if you have highly correlated factors, you could put 10 of them together and not get a whole lot of value from the additional factors. The ideal mix would be 2 positive mean factors that are perfectly negatively correlated, and then you need 2 of them. The answer is somewhere in between, and again, it comes down to just trying to understand how those factors work together, looking at the correlation and evaluating the kind of the incremental value add. And if you kind of plot that, across your factor model, as that curve starts to flatten out, that's probably where it's safe to kind of stop adding additional factors. So this question, is the moderate ridge regression weighting way better than simple equal weighting? So it wasn't. It depends on what you consider way better. We didn't plot that because it was was lower than all of the more complex metrics. But still, again, with lack of better information, it's not a bad approach. It was better than taking any of the single factors on their own. So would adding too much complexity result in lower returns, IR, and higher risk, combining value and momentum with quality growth, mean reversion, etc. So again, not a simple yes or no question. The more complexity you add, the harder it is to understand your model. Ideally, if you're blending many factors and those factors are positive mean and not perfectly correlated, as you blend them, I would expect your risk to go down. I think you'll probably reach a point where you might start detracting from the model, but really it'll probably just not add. You'll reach more likely you'll just kind of wash out the power and kind of reach a kind of that critical tipping point where adding the additional complexity doesn't help. Where it will add higher risk or create a strategy that's higher risk is when you start to add things that maybe you don't understand so much and that are really kind of more backfit models rather than things like quality, growth, value, and momentum that are have many years of proven value add and are well understood by the market. Can I share my thoughts on financial factors that have the most predictive power for returns? Sure, I can share my thoughts. Again, there are many different views on this. I think that, or for me, it makes me comfortable to invest in factors that have a history of performance, have been looked at by a lot of people, and are again well understood, well documented, and there's not much of a chance that those factors have been data mined. This is something that at Vista we stress in our process. We're not looking for kind of the new hot idea. We're always looking at new sources of data and new data items, new techniques. What we're finding is that, again, some of these are interesting, but really they're based on ideas that have been around in the market forever. They're just different ways to access them. So, people talk about credit card data all the time. All this is really doing is giving you insight into sales surprise or sales growth. Next question: what is considered a good R-squared in practice? So this depends on the type of model that you're running. If you're looking at kind of the 3 to 6 month holding period, if you had an R-squared of 1%, I'd say you're doing very well. If you have an R-squared of 5%, I would probably say that you're data mining your result. Again, though, that's not a set answer. A lot of it depends on the period in which you're looking and how you're evaluating your model. How do you decide which newer alternative data sets are worth testing? This is a good question and something that we discuss here often. So again, it comes down to the thesis that underlies the data set. Is it providing you with insight into something that is linked to the economics of a firm, and also breadth and history and cleanliness of the data. A lot of commercial data sets will be offered. They don't have much in terms of history, and you also have to worry about them kind of structuring data in a way that makes their results based on their data more attractive. I would say, ideally, if you could find data that's not commercial, those are the best data sets worth testing. As these things are commercialized, they get integrated into many processes. There are many dollars chasing them, and at that point, it's just the the value is kind of arbitraged away. So you spoke about addressing collinearity. Is the solution limiting the number of factors and using more skeptical models like the ridge regression? I would say that's one way to crack the nut. There are many. So we like the idea of the ridge regression, but there are other ways to approach that problem. So you can create factors that are orthogonal to each other. That comes with its own set of issues, and especially when you're trying to understand what those factors are, that's not so straightforward. So I think, I don't, again, no right way or wrong way, but there are many methodologies. All are very, probably have good areas of application. This is one of my favorite questions. How do you decide when to pull a model if it's not performing? Before you invest in a model, you should have some prior as to how it should perform in the future, understanding the environments in which it will underperform, understanding the environments it will outperform. And so you have some basis on which to frame the answer to that question. Again, there's no right or very straight, distinct answer. We evaluate our models over time. We're constantly evaluating the underlying economic intuition. Is there some reason to believe that intuition has changed? If not, then I would say pulling a model is premature. Certainly there are structural models, things like HFT, where the kind of the anomaly or the premia can be arbitraged away. And so you have to be very aware of that in those settings. When we're thinking about behavioral and financial data, it comes down to whether or not you believe that those long-standing ideas are still true or still hold within the market. And then how important, this will be the final one, how important is the trading cost research in ensuring your backtest results match your out-of-sample return? I would recommend you go and read the Andre Perrault paper on implementation shortfall. It's available on the internet. It's really old, but conceptually things haven't changed much. It's very important. So transaction costs and trading costs can create a very large hurdle, especially if you're not evaluating stocks in which your strategy is investing or controlling that in your portfolio construction. I think there are many examples of paper portfolios that are investing in stocks that really have no liquidity or have no access. When you try to put those in live, just fail miserably. Additionally, things like turnover matter when you're thinking about transaction costs. I think reversal is a prime example. It's very hard to harvest any actual return because the autocorrelation of that signal is so low. You're turning it over so quickly that your transaction cost hurdle is eating away all of your alpha. So that's all I have time for today. Happy to continue conversations or answer more questions offline in the future. But again, really appreciate the time, and hopefully this was helpful. Thank you.
Yeah, thank you very much, Chris. That was a great presentation. And if you do have a question that we weren't able to get to, you can email it to us at events@quantopian.com, and we will make sure Chris has a chance to look at it. Thank you, everyone, for joining, and thanks again, Chris.